Banking crisis the U.S. is experiencing right now has pushed us closer to a recession.
End of the American empire is here.
This becomes toilet paper, this little dollar.
Real estate's coming down, stocks are coming down. This is fake.
What we're witnessing here is the mood worsen, right? Investors really search for the next sign of weakness, the next domino to fall.
The once bustling stock market is now in turmoil, plunging in a downward spiral, causing panic and losses among investors. It's a dark and uncertain time as the market crash extends beyond just a single day, with no end in sight. Echoes of past historic crashes like the catastrophic 1929 stock market crash and the infamous 1987 October stock market crash haunt the minds of investors. But amidst the chaos, a well-known figure, the acclaimed author of the best-selling book Rich Dad Poor Dad, Robert Kiyosaki, has issued a chilling warning: everything will crash. What could possibly be the reason behind these dire predictions? Why is Kiyosaki sounding the alarm bells? In today's gripping video, we unravel the mystery behind Kiyosaki's ominous prophecies and uncover the truth behind the impending market doom. Imagine a whirlwind of excitement and anticipation as investors feverishly buy and sell, hoping to ride the wave of riches. The stock market, like a pulsating heartbeat, dictates the fate of economies and fortunes. But then in a flash, it all comes crashing down. This is the dreaded market crash, a sudden dramatic decline in the stock market index that sends shockwaves throughout the financial world. Market crashes have dire consequences, impacting not only the economy, but also the behavior of investors. When stock prices plummet, panic sets in, and fear drives many to hastily sell their shares in a desperate attempt to salvage what's left of their investments. The aftermath is often devastating, with portfolios in shambles and dreams of wealth shattered. The concept of a market bubble and subsequent crash is not new. Centuries ago, in the Republic of the Netherlands, the tulip market experienced a spectacular rise and fall that left its mark in history. In the 17th century, tulips were not just flowers, but a symbol of wealth and social status. The vivid colors and scarcity of tulips made them a coveted luxury item, and their prices skyrocketed to unimaginable heights. As the frenzy intensified, people from all walks of life, including the Dutch middle class and speculators from other countries, joined the tulip mania. They invested heavily, mortgaging their businesses and properties to partake in the lucrative tulip trade. However, the bubble burst suddenly and catastrophically. A widespread outbreak of the bubonic plague struck, and the tulip market collapsed, catching speculators off guard. The once exorbitant prices plunged, leaving countless investors penniless and the entire Dutch economy in a state of depression. The history of the US stock market is riddled with stories of boom and bust, with crashes that have reverberated through the economy and left lasting scars. From the Great Depression of the 1920s to the recent COVID-19 pandemic-induced market turmoil, these crashes have been marked by frenzied speculation, panic buying, and catastrophic consequences for investors and the broader economy. One of the most infamous crashes in US history is the Great Depression crash of October 1929. It was a time of unprecedented speculation, with shares of commodities like automobiles and homes skyrocketing in value. Unsuspecting investors, lured by the promises of quick riches, flooded the market in a panic buying frenzy. But when the market bubble burst, it sent shockwaves through the economy. Many investors lost everything, sliding into bankruptcy and triggering the worst economic depression in modern history. Fast forward to the 21st century, and we witness the stock market crash of 2007-08, which had a different trigger: the collapse of mortgage-backed securities in the housing sector. High levels of speculative trading had caused these securities to rise to unsustainable levels, only to come crashing down as housing prices declined. With homeowners unable to meet their debt obligations, financial institutions crumbled, leading to the Great Recession that had far-reaching consequences for the global economy. In more recent memory, the COVID crash of March 2020 caught the world off guard. As the COVID-19 pandemic spread rapidly, governments around the world took drastic measures to contain the virus, resulting in widespread economic shutdowns. Sectors such as healthcare, natural gas, food, and software were severely impacted, and the unemployment rate skyrocketed, causing a market collapse that sent shockwaves through the financial world. These crashes serve as stark reminders of the inherent risks in the stock market and the far-reaching impact they can have on individuals, businesses, and the overall economy. However, the financial world is abuzz with recent warnings from Robert Kiyosaki, the author of the best-selling book Rich Dad, Poor Dad. With his uncanny ability to predict economic trends, Kiyosaki has raised eyebrows yet again by cautioning that stocks and real estate are on the brink of a crash, and the US economy could be in for a rough ride. Having spent over 6 years in the New York Times bestseller list, Rich Dad, Poor Dad has captivated readers worldwide. But it's not just Kiyosaki's book that has garnered attention. His recent tweets have been causing a stir, citing the staggering job losses of more than 144,000 people in the tech industry in 2022, with 66,000 more already let go this year. Kiyosaki has been sounding the alarm bells. In a tweet that caught the attention of his 2.3 million followers, Kiyosaki boldly declared that everything will crash. But he didn't stop there. In his trademark blunt style, he urged his followers not to panic, revealing his plan to use fake dollars to buy more gold, silver, and Bitcoin, which he referred to as real money. Kiyosaki has long been vocal about his distrust in the US dollar and the government's handling of the economy. He has repeatedly stated that gold, silver, and Bitcoin are real money, as they are not tied to the full faith and credit of the United States like the dollar, which he considers fake money. With a track record of warning about market crashes, including what he calls the biggest crash in world history, this financial guru has been cautioning investors to be prepared for the worst. In October last year, he warned that the stock, bond, and real estate markets would crash as the Federal Reserve continued to raise interest rates. He even predicted that Bitcoin investors would get richer when the Fed pivots and prints trillions of dollars, further highlighting his keen insight into the complex world of finance. In a recent interview, he expressed his concerns about the excessive money supply and the potential consequences of raising interest rates. He pointed out that a recession could crush small businesses and create turmoil in the bond market and the repo market, which are critical components of the financial system. He highlighted his concerns about the government's handling of the economy, referring to them as incompetent and socialist, and emphasized the risks associated with unsustainable levels of debt. Drawing on historical events such as the creation of the Federal Reserve in 1913 and the abandonment of the gold standard in 1971, this financial expert presents a compelling argument for why the current financial situation is precarious. He highlights the massive amount of money printing by the governments, with trillions of dollars being injected into the global economy in response to the pandemic, and questions the sustainability of such actions. He warns that this unprecedented level of money printing may have severe consequences in the long run and underscores the importance of investing in assets like gold and silver as a safeguard against potential economic collapse. This financial guru is not shy about criticizing what he sees as the incompetence of policymakers and academics who are detached from reality. He points out the numbers indicate that we are already in a depression, with economic growth slowing down significantly. He cites examples of historical events such as the euro-dollar curve inverting, which has preceded previous financial crises, including the Lehman Brothers collapse and the COVID-19 pandemic. But it's not just the economic indicators that are ringing alarm bells for Kiyosaki. He points to the growing trend of Marxism in America, citing the unrest in cities like Portland, Seattle, New York, and Chicago. In fact, Kiyosaki is so worried about the direction America is headed that he has taken drastic measures to protect his wealth. He has started storing gold in Switzerland and Singapore, preparing for the possibility of having to flee the country. Kiyosaki believes that most people don't understand the fundamental difference between a Marxist and a capitalist. He learned this firsthand during his time in military school, where he was taught that socialists have historically been responsible for more deaths than capitalists. He rattles off chilling statistics of millions of people killed under socialist regimes, from the Nazi Party to Stalin's USSR to Mao Zedong's China. He argues that Americans go to war to fight against socialism and protect capitalism. Kiyosaki also provides an insightful historical perspective on how the Communist Manifesto was designed by Marx to transition societies from agrarian to totalitarian, with capitalism acting as an intermediary stage. He points to China as an example, where Mao initially embraced capitalism to bring prosperity to the country, but now Xi has become a totalitarian leader, cracking down on capitalists in Hong Kong and potentially posing a threat to Taiwan. However, coming back to the stock market news, and despite recent strong performance of the stock market, with the S&P 500 up by 7% in the first quarter of 2023, there are growing concerns among economists and market analysts about the sustainability of this rebound. The stock market had a rough ride in 2022, with a significant decline of 19.4%, and while recent recovery is encouraging, there are warning signs that point to potential challenges ahead. One such concern is the inverted yield curve, where long-term bond interest rates have fallen lower than short-term bond rates. This phenomenon has historically been a red flag for an impending economic slowdown. Andrew Slimon, the head of the Applied Equity Advisors team for Morgan Stanley Investment Management, expressed his worries about the possibility of a weaker second half of the year in a recent research note. He pointed out that the stock market could face risks in the latter part of 2023, despite a strong start in the first half. Slimon is not alone in his concerns. Other market experts are also aware of the Federal Reserve's approach to fighting inflation through interest rate hikes. If the Fed continues on its current path with no signs of easing off, it could potentially impact the stock market negatively in the coming months. As the years progress, investors and analysts alike will be closely watching these warning signs and assessing the risks to the stock market. While the recent performance has been encouraging, there are still potential challenges on the horizon that could impact the US economy and stock prices. Investors need to remain vigilant and make informed decisions in the face of uncertainty in order to navigate the ever-changing landscape of the stock market. Now, let's hear your thoughts about Robert Kiyosaki's warnings in the comments below.